Nobody is irreplaceable. Organic growth is actually not going to make the trick to get us to 100 million.
Bank doesn't really care you have a bad month. If you just are not able to pay their interest, they will seize your assets.
We've someone special back today, Francine Gervazio. And when she was with us the first time on the show, she was about to sell her company. And now she's back and she's acquiring. So today, her and her CFO sit down with us and explain how they actually acquire, finance, and integrate companies on the way to 100 million ARR. They got very specific, and what we really enjoyed is they were very honest about the entire process. So we hope you enjoy this one too.
I think when you're going through due diligence, there's always a lot of things that you're not super comfortable with or that you're like pointing fingers. But then 1 month later, you go to a board meeting and all of those things that were really bothering you, now they're your problem, right?
Buying a company is very exciting, especially if it's your first time and you really feel like you want to celebrate when the acquisition is done. But then there's the realization the next day that now the work actually begins.
This is Melanie.
And this is Christian.
You're listening to Follow the Gradient, the weekly podcast with actionable insights about how to build a business while staying sane. Francine, so great to have you back. Last time you were here, you were preparing to sell a company. Now you've bought two and you're approaching 100 million ARR. Take us to the specific moment when you and Wouter looked at each other and said, organic growth isn't going to get us there. What triggered that shift?
Hi, Melanie and Christian. So first of all, it's great to be back. Thank you for having me. And now this time with my CFO. I think it's interesting, right? Wouter and I will look at each other and basically said, hey, shall we move into a bit of a buy and build strategy? Because organic growth is actually not going to make the trick to get us to 100 million. Why did this happen? I think when we look at the fleet market, it is super fragmented, yet quite unpenetrated. Let's say about 80% of the market is still white space, which means that there's a little bit of a low adoption curve in terms of SaaS. But on the other hand, you have a lot of players doing a lot of different things. So what we also know is like from our learnings back at Avrios and also with Vimcar, we spent a lot of money trying to grow organically or launch a new product line. We spent lots of money on development, trying to build this new feature or open an office in France and something, and it just didn't work. It's slow, it's expensive, it's risky. It's probably going to take you 10 years to pay out. Looking into the opportunities, the dynamics of the market and the learnings from what we had before, plus also looking into some dynamics of M&A in our market, which means companies trading at some attractive multiples. We basically looked for a financial partner to support us on this journey.
And now, what you were just saying, like, I feel like every founder at some point faces the same decisions, like the question about, do we build this ourselves or do we buy it? And many startups burn, as you said, a lot of venture money trying to expand, trying it themselves because they know best. We all think that we know it best. But then we hope we grow, but we don't. So what was the moment, Wouter, maybe where you realized if you want to grow at the speed and the magnitude we're aiming for, acquisition is actually the better path, also from your CFO perspective?
Yeah, thanks, Melanie. So I think it's a combination of several factors, right? So one, at the stage of the company we are, with the type of shareholders we have, our financial profile, we have different options, right? So first of all, it's an option to buy. I think that there it starts, right? Not every startup will have the option to buy. You either don't have the cash, you don't have the profit or debt, you don't have the maybe shareholder appetite, right? So I think that's question number one. And then the second is there's a difference between the risk and the reward. If you buy a company, you're buying a certain skill already, you're buying historic performance, you're buying retention of customers, you're buying an existing product or capability within the team, which if you're developing greenfield, none of that is proven yet, right? So the upside is massive, but also the risk, of course, is massive, and it can take a long time to pay off. Yeah, so for us, in this case, seeing a certain constraint on our ability to do it organically in a certain time frame, acquisitions just were a natural option to explore or move into, simply because it provided scale within a certain time frame, rather than developing a market one AE at the time or developing a new product, hiring engineer by engineer and taking the time to do right. At the same time, from my perspective, depending on who you're buying at what price, there's also immediate equity value you're creating. So if we look at a fragment market with certain legacy players, maybe some still have on-premise software, etc. You're buying a company maybe at a 3-4x multiple, sometimes a bit lower, a bit higher. If we're looking at our company with our scale and really pure SaaS, you're probably trading at a somewhat higher multiple. So as soon as you fold the other acquisition into your group, really properly integrate them, start realizing some of the synergies, you have immediate equity value creation there. Yeah.
And now, when founders or also other people look at acquisitions from the outside, sometimes it looks like it's a very opportunistic deal making. But we all know that in reality, it is usually and hopefully also more strategic and really a strategic reason behind it. So maybe also I want to know what your specific strategic reason was besides the growth aspect, but then also maybe walk us through, for those who haven't been in the process of acquisition, what are the typical reasons you might buy a company?
So I think there are a couple of different scenarios, right? One thing is that is also important to understand is what is your universe of companies available to buy? What is your vision and how can we match them? But usually I think there are three obvious ones. One is you just acquire a customer base, right? You buy more of the same in a similar place. You want to grow, you eat your competitor. That's pretty straightforward. It works really well. And it's probably the easiest one. Then the second one is you open up a new geography, right? I think in the case of Shiftmove, we actually did a bit of both, right? We opened up France and then we got more of the same in France. And then the third one, it's more adding some skills that you don't have. It can be a new product, it can be even a technology or some skills within a team. I would say that for this third one, there are not many cases available out there and it's not so obvious, at least in our case. But these kind of acquisitions, they are, some people might say, hey, that's a shortcut to growth. I tend to disagree because integrating is actually a really struggle and it's a growth pain. But it's a good way to grow at a relatively lower risk.
I feel like that one factor also today in the current market environment is that many startups have raised at very high valuations a few years ago and are now struggling to grow into them. And so they become also a target for competitors, let's say, that are maybe better set up. So that really creates a situation where it can also become that when joining a bigger platform, it might actually be a better outcome for founders and investors that are in these super high valued startups, but that don't really see an exit case. But the exit case could actually be that you join a bigger one, and with that, you believe in the long term and see there the exit or the return on investment. So, how much does today's market dynamic influence the M&A opportunities that you two see?
Yeah, just a personal note, I think there's some opportunism in M&A, certainly, right? If you look at your potential market, it is limited, right? There's not millions of companies you could buy, and not all of them are open all the time. So you have to be in constant touch with the market and spend a lot of time talking to other CEOs like Francine is doing, to make sure you're always in touch with what's happening and who's potentially open to sell. Now, of course, it is a very attractive option. One, because generally strategic buyers, such as a platform like ourselves, typically pay a bit more than maybe an institutional shareholder or like your private equity or venture capital, simply because we have immediate synergies. So I think there's immediate value creation just by combining our platform with this new acquisition. For founders, it could be attractive because if you look at the current market, there's quite a lot of startups that, thinking back about when we sold Avrios, trade at quite high multiples, that raised funds at quite aggressive multiples. Thinking back to 2021, for instance, and 22 even. And if they would need liquidity today, that would be tricky. But getting into a platform that has a bit of a longer view, like ourselves, that is definitely interesting for them if they want an exit, but also if they want to roll over. And then if they want to roll their existing shareholding into a larger platform, they can sit it out a bit longer, but also they have a small share of a bigger pie, which is also an attractive strategy.
Yeah, maybe to add here, I think that especially in cases where investors are not desperate for liquidity, but would rather get their returns being part of a platform and kind of like joining a more certain investment thesis, such as you get a much stronger company with stronger financials. It's difficult to break, and you can only create more value out of that. It's a good strategy to roll over, as long as what is the ultimate goal of this platform. Especially, I think if it's a private equity backed company, I think it's a pretty straightforward, or VC, right? That in an X amount of years, they will probably sell, and then you can have your liquidity event. So the returns there are much more certain than if you as a founder are being squeezed by your investors just because you don't know exactly what you're going to do to make the returns and you don't have enough cash to acquire a company. Or if you sell, you might get zero because all your investors are going to get the returns and you as a founder are left out with zero. So yeah, that can actually be a very good opportunity for a founder and also for the platform, because then they can also acquire at a good price.
Very much.
And I just want to challenge this narrative here for a second, because I think critics of buy and build strategies often say that it's all just financial engineering. You acquire revenue, you call it growth, and then eventually you can sell the platform you acquired to someone else, be it private equity. So what's your answer to that when people argue that way?
There's some form of truth in there, in that, like I said, let's say you buy a company at a 3x ARR multiple, and then your own company maybe trades at 6, and you, on paper, you immediately say, oh, we're now combined at 6 shareholder value. But there's two things there. One is the buyers aren't stupid, right? They will see through this immediately. If someone is going in the D and they're going to look at your company and they see they have a non-integrated part of your company that is not integrated in any way, the products are not integrated, there's no synergies and lower operating expenses, there's no shared functions whatsoever, they will see this and they will just price it differently. They will see that a year ago you bought something for a lower valuation, and they're not going to give you a lot of credit for that right now simply because you didn't do anything to it. So I think maybe on paper there is that value creation, but in reality, if it actually comes to a liquidity event, you will get punished for that. But of course, if you do integrate, if you do actually create one solid company, you will see those returns, right? So if you, for instance, in our case, there's a lot of cross-selling that is part of our strategy. We have multiple products, and it is part of our strategy that with these recent acquisitions, we cross-sell some of our products that we had before into the customer base that we recently acquired. Also, we are sharing certain functions that were more developed and mature in the initial company, and then scaled those functions to the acquired company to make sure that as a group we became more efficient. Also, there the sum here is greater than the parts, and I think that will eventually pay itself out to the shareholders here. Yeah.
Yeah, and maybe just something to add here. Whilst this is not public or clear in the market, what is the premium you get for having a clean company, right? When you do a buy and build strategy, and the fact that you're not a Frankenstein, what is word out there says you get a 1 to 2x improvements on multiples in terms of valuation. But I think valuations, they are just a result of a high quality company, which actually means that we're actually creating value out of this growth that is inorganic, but really pursuing the sort of like vision that we are aiming for the future.
And you hinted at it, acquisitions are not just strategy, not just a CEO game. It's also about financial architecture. And Francine, last time you were here alone. Now you brought Wouter along as the CFO. So Wouter, maybe to take a step back, when a company moves from the startup mode to really a more advanced mode and wants to execute buy and build, how does the role of the CFO change?
So speaking from personal experience, thinking back about the times working at a startup is just generally more uncertain, right? It just moves at a really high speed, and you might have a plan for the next 3 months, even 12 months, but we all know that a week from now, that's all outdated, right? And the plan is completely upside down again. And so I think it's my role, you're much more looking at your current burn rate, your current tracking of different initiatives, generally more operational, and just really more of reporting what's happened and then calibrating what's next. Whereas now I would say I'm working more on a long-term strategic vision of where we need to go over several years. And also the path there is more predictable, but also it is more deliberate, right? There's a long-term horizon, and there are very clear ways on how to get there with, maybe less risk And that changes your role quite a bit. That's of course also driven by simply having a different type of shareholders, right? If you have venture capital backing you up, then the base expectation is usually something like 200% growth or become the next unicorn. And it's all about upside, right? If you have a private equity investor, they're working a bit more on a certain level of certainty, right? A certain return after X years. So that also means that they will focus more on things like your customer retention or the rule of 40 or 50 or even 60 in some cases, right? Also the likelihood of a credible exit. So the objective changes, and as the objective for the shareholders change, that also changes the role of the CFO in achieving those objectives, right?
Yeah, if I were to add something here, I think CFO right now is basically the gatekeeper of the business because the business just go through so many different areas. For instance, imagine we acquire a company that has one team operating in Morocco and they need someone, they just call HR goes and hires this person and nobody knows about it. What we need to do is once we acquire companies, like the CFO needs to have something set in place so that the person that is here in Morocco that is just to call the HR person is not allowed to do that hire if it's not fitting into the plan that we have right now. So basically just cascading to the entire organization this level of control because it's extremely important as we need to, let's say, value exactly the return on the acquisition that we've made. It becomes quite complex, but at the same time, I think it's quite rewarding.
What is the biggest challenge to really exert this control? Because I could imagine it's also a balancing act between keeping control on the one hand, but also pushing for autonomy. Because usually what we see in decision making, the smallest unit of decision making can make the best decisions. But you obviously have to somehow make sure that everyone is pushing into the right direction. So what's your biggest challenge there?
Probably data. So transparency on data or data availability, quality of data. I think that's the biggest challenge, right? With every acquisition, you're most likely buying a very different set of tools, infrastructure, and data. And therefore, you're either comparing apples to pears, if there's even something to compare, right? If you're buying another company, your main KPI is just to keep it simple AR. The other company doesn't report an AR. That's already gives you your first to do on your to-do list, right? And then the second challenge is once you maybe define a common KPI and start tracking it, is also you need to make sure that the people that are tracking it have the same definition as you and are actually working on it every day and speaking the same language. And so there's a lot of assumptions you can make early on about, oh, aren't we all speaking the same language? We're in the same industry. If I say, what's the ARR, what's the gross retention rate, etc., I can just assume that we're talking about the same thing and that therefore I have full understanding of the business. But that's a very risky assumption, I think, and that's definitely something that's important, right? And if we're all speaking the same language, if we look at the same KPIs and the same numbers, then you can give a lot of autonomy because you can always step in if you're feeling it going the right way, right? So you can trust until the trust is really broken, so to say. Yeah.
If we turn to the transaction itself, many founders out there think acquisitions are super simple, right? You raise money, you buy a company. But then in reality, speaking of financial engineering, you obviously have a lot of different tools at hand. And I think also in the market, we see a lot of companies acquiring business with debt, while other companies might go the usual equity route. So maybe Wouter, walk us through the different advantages and disadvantages of using debt versus raising equity. And what's your mental model you recommend people to execute to decide what route should I actually go?
Yeah. So this is really where you as a CFO have a relation with your shareholders and also the way they think about your business and in the end, how they want to create value for themselves. And in the terms of debt versus equity, that's a very strong or very material part of that relationship and quite an important discussion. So first of all, with debt, the main advantage is that it simply doesn't dilute existing shareholders, right? So if it ever comes to an exit, it is more accretive to shareholders to have debt rather than to put in new equity, right? Also, especially with an acquisition, timing is very relevant, right? You have an opportunity, you can engage, you can maybe acquire, and there's a timeline to execute on. There's a due diligence that's maybe fixed for a certain period, and you need to get your funding together in that fixed period. Raising equity is not something you can easily execute in 1 or 2 months, whereas that is. So that just generally is easier to execute, is faster to execute. And if you're we talked earlier about opportunism. If you're in an opportunistic, if you have an opportunity, you want to seize that, right? And then that can be the thing that actually helps you seize that opportunity. Yeah. The thing is also, if you think about the type of company you are, your financial profile in terms of your profit, your cash flow specifically, right? But also your growth profile. It might be that you're simply not attractive to investors, or only attractive at the wrong or bad financial terms. So for instance, if you're a low growth company, you might not have a lot of investors that are really willing to buy into you. But if you're low growth, but you have a very healthy cash flow and a very healthy ratio of profit to debt, then there are a lot of lenders available that are more than willing to provide cash to you on good terms, right? Yeah. So it depends a bit on the profile of your company, and then that kind of risk profile then makes you either suit better for investors or lenders. And then you really can compare the terms. And of course, also then you have a discussion with your shareholders to see what is better for them in the end. Is it debt or dilution of their shareholding? Yeah.
Francine, in our previous conversation, I think you said something that really stuck with us. The rule of 40 is king. And we talked a lot about that last time. So maybe now with the context of executing acquisitions, does that metric now also become part of how you evaluate targets, potential targets, before you may acquire them?
Yeah, so I must say that the situation actually even changed. Now it's rule of 50. So it just got a little bit tougher. But it's not as much like in the acquisition side, if they're on rule of 40 or 50, or however we're going to say. But how can that influence into our rule of 50? Or our rule of 40, right? Because you might be able, if it's a smaller company, for instance, you would look for a higher growth, and that can help to push the growth of the business, and you're probably already quite profitable. So on the profitability side, you don't need much of a balance. So I look much more now into how can this plug in into the way we want to push our rule of 40, because it's always also very nice to balance, right? You don't want to have a 40% profitability with a 0% growth. You want to have this balance. So it's also, hey, we don't want to get companies that are going to damage one or the other profile that we have. And really, how do we look as a whole?
Maybe building on that point, how do you know if your company can actually afford an acquisition? What are the financial signals that tell you it's too early, we shouldn't be doing this, we need to fix something internally first, or we can actually go ahead?
Normally, you look at many different metrics to judge whether you're doing right. Maybe it's your ARR growth, maybe it's your revenue growth, your EBITDA margin, your free cash flow. But often you don't look at things like your net debt to EBITDA ratio and other metrics like this. And these are actually the things that for a lender matter, right? So this is what you call your covenants that you have with lenders, right? And you have a certain headroom, which means like how much more debt can I carry before I meet with these covenants, right? If you're a bit more early stage and have a bit more growth, then typically with a lender, you would have some sort of agreement on what the ratio of gross debt should be compared to your AR. If you're a bit later stage and you have sufficient and predictable EBITDA margins, then it's more typical a ratio of net debt versus your EBITDA. And that ratio already tells you how much more you can lend. So if the relation is 5 times debt to AR, then you know current AR times 5, that's how much debt I can carry. And then you can talk to a lender and understand what your capacity is for more debt. So first of all, that's one. Second is you have to pay interest on that debt. So you have to make sure that you have enough cash every quarter or month or whatever period to be able to service that debt. Because the things with lenders, different maybe to shareholders, is that a typical bank doesn't really care you have a bad month. If you just are not able to pay their interest, they will seize your assets. They care about predictability, and they want to de-risk things. And yeah, they're not in it for the long run per se as your shareholders, right? They want their money one way or the other. So I think you really want to make sure that you can actually afford the interest on your debt, right? It's not free money. And then maybe a third thing, it's not even financial. I think it's more basically every conversation Francine and I had around an acquisition was, can we deal with this? We have a lot on our plate. Our team has a lot on their plate. If we now put an acquisition on top, does it risk any other major strategic projects and work streams we have within the company? E.g., if we do this acquisition, will it damage the company in any other way, right? So you also have to be really ready to spend a lot of time mentally and physically on this acquisition to make sure you can actually deliver on the plan there, right? You probably have some sort of idea of what you want to do with this acquisition, and you need to be able, you can actually execute yourself, or your team can execute on that as well. Because the truth is that buying a company does cost a lot of time, energy. There is a limit to how many you want to do at the same time. Yeah.
Yeah, and I would say our business plan, let's say for the platform, we don't get credits and more money to professionalize our team because now we have more companies. So basically, it's not only the money to acquire and to pay for this debt, but actually we need to scale our business as a whole. So I need more experienced executives. I need to step up my finance team. I need to get the senior leadership. I'll have attrition, so I need to deal with attrition. And this is not like I don't get bonus points on my P&L to add more costs to deal with all of this, right? So we do need to balance and not look into the acquisition only. And I think this goes a lot into what Wouter is saying. That is like, what is our ability to deal with this business later on? And do I actually need to maybe create one more leadership layer on the product to have someone looking into the product globally? Or can my CPO deal with the different product lines? So those are some of the questions that come in later. And many times you won't have the answer and you are going to have to deal with restrictions.
Do you have one question a founder could really ask herself or himself, am I ready to do an acquisition? Like the most important thing to look at?
Are you willing to spend some months or at least the first 2 years of your acquisition going through ups and downs until things start working? Because I think it will take about 18 to 24 months to look at this and say, hey, I have transformed this business. So it's more, are you willing to do that?
Yeah,
I don't know.
I think just to comment on that, I think the truth on that is probably that the acquisition is not done with the transaction. It's like post-acquisition is when the work starts. It's the same in, I don't know, sales and customer success or whatever, like the real work. And I know that no salesperson likes to hear that, but the real work starts after you've closed the contract. And that's probably in the transaction.
Yeah. So buying a company is very exciting, especially if it's your first time and you really feel like you want to celebrate when the acquisition is done. But then there's the realization the next day that now the work actually begins, and now this time you're accountable, right? So all the things you didn't like during acquisition that you used to point out and say, this is not so great, so therefore we're going to challenge this seller on why the price should be lower. And then a day later, basically you're the one that has to fix it now and report to the board why it isn't fixed yet. So I think that's the reality there. And you do need to be able, or you do need to maybe expect that you might need to step in, right? If you buy another company, maybe some people there don't agree with the route the company has taken, right? And they leave, and then someone still needs to be there and lead that team. There's a lot of people maybe that have some uncertainty about their job because they now they're part of a bigger thing that they didn't know about yet, right? They just heard the company got acquired, that they have a new boss, etc. And there's a lot of uncertainty, and you have to be there to help people see the bigger picture and to take them on this new journey. And that requires hands-on leadership. And luckily we have Francine, who speaks a dozen languages, who can go there and then connect to the people and show empathy and really take them on the Shiftmove journey. But I think that's definitely something you have to be ready for. You just buy something and let it sit on the side. It won't become one company. It will not integrate into your group, and it will not add the value you're seeking there.
Yeah, plus I think when you're going through due diligence, there's always a lot of things that you're not super comfortable with, or that you're like pointing fingers in the management meetings, and you still buy the company. Like these are not like deal breakers. But then 1 month later, you go to a board meeting and all of those things that were really bothering you, now they're your problem, right?
Yeah.
Because I'm not there to blame anyone. I took the responsibility, right? So if we have acquired this company, they're part of our group now, and I'm the CEO, so I'm the one managing it. So it's my problem to solve. But 2 months ago, I really hated that problem, and now I'm the one dealing with it, right? So I think it's super important to change this mindset, because the board is expecting, like in the next board meeting 4 weeks later, that we have everything under control.
And I think this part of like switching this mindset and also see different perspectives is also something that you both have gone through, because you were at the other side of the table a few years ago, and now you're basically the ones acquiring others. So my question would also be, since you're now on the other side and you're acquiring companies, how did going through that experience maybe also change the way how you treat the founders you're acquiring today?
Yeah. So I think it's a lot of relationship building, to be honest, as well, right? A founder, unless it's a fire sale where someone is really desperate, which, to be honest, it doesn't happen every day, will think 10 times, is this the right buyer? Am I doing the right thing? So even though maybe the financials work, there is also an emotional effect on this. What is going to happen to my company after? So for me, especially, having gone through that. I think it's a lot is on the CEO to build these relationships across years. And I do that for like quite intensively, but I do have a lot of empathy for what they're going through. And this actually helps a lot to connect and therefore to give the confidence that they're doing the right thing. And as a result, you get people to open up and then you get the information you need. So it's really emotional. It's not as mathematical one would think about, but it's definitely it's like buying a product, right? Or selling a product. We're talking about people here. So you cannot underestimate the power of a relationship here.
If we now again step back and talk about also the selection process, we have talked about like that there are not hundreds of companies that are potential acquisition targets, but still maybe let's look a little bit deeper, because once you start looking at acquisitions, at first the universe is huge and you feel like yeah, here and there, but then you go into the nitty and gritty. How do you actually narrow down which companies are actually worth pursuing? Because as we just heard, you spend so much time afterwards, but you also already spend a lot of time figuring things out. So somehow it must be worth that at least you spend time on due diligence and everything just from the outside.
So I would say it's a sales game and you are landing a big deal, right? And to land a big deal, you need to build pipeline. And for that, you need SDRs, you need a very strong AE, and that's a little bit how it works. So in a bigger company, you would have a corporate development team, and these people are basically just screening the market, talking to everybody. In our case, we are a small company, so we can't afford to have a corporate development team. We work very much as a team together with our investors. And we have people out there that are usually these SDRs that we would call. And it's a partnership, right? So they help in one hand. And then I'm also really like screening the market. We have our salespeople, our customer success people that are talking to customers. I'm going to conferences, right? I'm meeting people, word is out there. So we just map as many companies as possible. And we also make the market aware that we are acquiring companies, because once companies go to the market, they reach out to us, right? So it can be an inbound from bankers, but also there are companies that I wish I could buy tomorrow. They're not willing to sell, but I'm bothering them every other month, trying to build a relationship and finding a good fit. And then once you do that, you still have to make the economics work, right? You need to offer a price that they are willing to accept. And if they go to the market, you need to offer a price that is competitive enough so that nobody is making a higher offer and you are losing the deal. As we lost a couple of deals recently for price as well, just because we couldn't afford it. And it's not as simple. You just need to put all of these things into perspective and make it work. And that's why it's this constant sales pipeline and this constant sales game until you land those big deals.
When you are in the process, due diligence, we alluded to it a little bit, and also about the messiness and about the different definitions that you then find out afterwards. But the reality of due diligence and the messy part of it, I would like to dive a little bit deeper with you too. What are the most common surprises that you have encountered during due diligence? Without naming names.
I'll just say the one and then I'll let Wouter, because I think he has a big list, way bigger than mine. But one thing is, I think every single decision that when you're in a sales process, you postpone every single decision because you're like, okay, the next buyer will deal with it. A promotion or improving a product or a negotiation with a customer. These things you don't know in a DD. So from day one, everybody will expect that all of these things will be solved yesterday, sorry. So you probably have 15 people waiting for a promotion. I think that's just a classic one. Yeah.
Yeah.
Do you have
And
anything to add here?
to extend on that, I think during a DD, you mostly focus on what's documented, but it's the undocumented parts of the business that are the riskiest, right? So if we're thinking about employees or anything where there may be people-related issues that are currently still being discussed, whether it's this person doesn't like that person, these cannot work together anymore, whatever, this sort of stuff, you won't find in a virtual data room, right? But they will, in the end, lead to some extent to some financial or legal liabilities. But also on a customer perspective. So one thing I will usually early on ask whenever we talk about products and especially product development and customers is, one, is there anything that we promise to customers that we'll build for them? Because it typically means that somehow, somewhere in AE told a customer, yeah, we're going to build this for you. Don't worry about it. So either we're going to lose that customer once we acquire it and we decide not to develop it, or we have some big development project that no one knew about yet. The second also is there customization efforts. If we have a standard SaaS product and it's claimed that there's no customization, but then you have a few big customers that really get most of their value from the customization, it means that you always have a part of your engineering team busy on maintenance for those customizations. And that changes the plan again. So you have to understand all these kind of off-paper liabilities and commitments to fully understand, to make sure you don't have any nasty surprises afterwards. Yeah. And then, there's a long list of other stuff that different per acquisition. What I wish I would know upfront and didn't, where it was assumed it was immaterial, and then it turns out it is material. The truth of the matter is that usually you take some sort of sample check. You're not going to check every single customer contract. You're going to check every single invoice. I think in the future, AI will make due diligence a bit better. But so far, you do a sample check, and that means you accept some level of risk. And that sometimes also means that things go a bit different than what you expected. Yeah.
And in all fairness, I think it's not like the one thing, but it's just that it's a combination of a lot of small things that just take a lot of headspace.
100%.
Yeah.
Yeah.
Take a lot of energy, and that you should be focusing on driving the business, pushing cross-selling, getting your sales team to buy your vision, right? So you just get distracted.
To move directly to that point, many acquisitions fail or in the end succeed because of integration or what happens after the transaction. We spoke about that earlier. And one assumption we hear again and again is you always have to protect the legacy knowledge in the acquired company because it's people who understand the business very deeply. It's knowledge which is nowhere documented. So at the same time, many leaders say that sometimes fresh energy and new leadership is needed to really integrate the business. How do you think about that balance, or how do you approach that?
Yeah, I think this is something that we've been learning on the hard way and has been improving with time. From my point of view and my philosophy is, if you're not aligned with the culture and our way of moving, I think that there is no risk of losing knowledge because this person is going to be out, or the person will leave, or 6 months down the road, we're going to need to take this person. And in the end, we all know the industry really well, and we're acquiring companies in our industry. It's not rocket science. In our case, we're not like buying a huge technology specifically. It's us, it's in our industry. Everybody can work through it. Nobody is irreplaceable. So from my point of view is, if you're not aligned with the culture and our way of working, I'd rather to replace as soon as possible.
I also think that it depends on your integration plan, right? If you're planning a full integration and you're changing within the function a material amount of processes and systems and the way you generally work, then the legacy knowledge, of course, itself will just become less valuable over time. And then the question is, do you want to optimize for that brief period of transition where legacy knowledge is still relevant, or do you want to optimize for where you want to be a year from now or 2 years from now? And the truth is that usually it's the second. Yeah.
I think another learning you mentioned in our prep conversation was that the different teams were integrated in different ways. So in some areas you integrated very quickly and formed one new team immediately. In other areas, you let different teams run in parallel for longer. So looking back, like, what have you learned about how quickly should integration actually take place?
I think there's some level of personal preference, but definitely I've come to prefer faster over time. I think every integration we've done, afterwards I regretted not doing it even faster. I think the first thing, especially for me, would be that to get reporting on. So earlier we had this discussion on speaking the same language, tracking the same KPIs, etc. I think really the whole finance, go-to-market reporting should be one of the earlier priorities. Definitely learned that the hard way, because in the end you can't really manage it right if you don't know what's actually happening, which customers are churning. How can you intervene? How can you really manage it right? Then there's also a lot of short versus long-term debate. So you might say about your sales team, what if we make changes now? It might distract them and our bookings go down, right? Yeah, maybe on the short term, but long term, if you don't integrate them, how can you profit from any of the potential synergies of cross-selling products or positioning differently within the market, et cetera, right? There you have to really think about your business plan a few years down the line and seeing where do I want to go, and then make a trade-off between maybe making significant changes now, but potentially killing some momentum with your sales, right? Or delaying some of the changes. And again, I prefer now to do it rather faster than later, because in the end, I think any change will still take the same amount of time and will still create the same amount of distraction, whether you do it now or 1 year from now. And it's probably better to just get it over with now, since that everyone, right after an acquisition, everyone is in the change mindset, right? Everyone expects changes to be made. No one is getting bought or acquired and expects everything to stay the same.
Yeah.
So the mindset is actually there and they're willing. If you're 1 or 2 years down the line, it's maybe a bit different and you just lose a lot of momentum on the integration, right?
Just one thing that we have underestimated is just blend your communication tools on day one. Microsoft Teams, Slack, whatever, you keep all of these different setups. With our first acquisition, we said, hey, let's keep it separately. And then on the second acquisition, we said we start on day one. It was so much better and everything just worked very much much easier after that. So if someone would ever think about, do I keep Slack and Microsoft Teams or something separately, I would say just move them together on day one. It makes it much easier.
Culture is obviously a very huge factor in all of this. And Shiftmove is known for a very fast and execution focused culture. So, how do you integrate teams from different companies and often different countries without forcing everyone into the same mold?
Yeah, so it's definitely a challenge, but I think that if we want the company to move fast and be aligned, we will somehow need to push them into a mode. And this mode is actually basically aligned very much with our company values, and we try to put them at the core of everything we do. So we actually don't make things too complicated. We just make things like very straightforward. So we focus a lot on open communication, which means that especially in the beginning, we host quite a few AMA sessions and just roll like the truth and whatever is happening. It's very interesting that the questions that come usually once an acquisition comes in, they're always the same. So it's almost as if we already have a playbook book, because it's usually people are afraid, oh, am I going to lose my job? What's going to happen with my benefits? What will happen to our product? So there are many of those questions which we just address very openly. And then what I was mentioning about our values, right? We have defined our values and we just build, how do I say, the performance management. We give praises to when an action is taken, you are aligned with our values. And we also do train quite a bit middle management. So I really believe that middle management is a very powerful tool to really spread your culture across the board. Because me as a CEO, I can come in and all hands speak for 20 minutes, but then everybody will go back to their work and they will talk to their manager every day, right? So if their managers, they are empowered and they're aligned with where the company is going, then we really can push the culture that we want. So from my opinion, it starts a lot with this layer. So one example is one of our values is make it happen, which I think it's aligned with what you mentioned on the execution focused culture. So when people start overcomplicating stuff, delaying deadlines, we tie performance to the values. And I think this actually helps a lot to reshape the organization, and who is not fitting it organically is leaving, and the people that actually are really aligned, like we've seen cases of people really reaching their potential way more than what they were being used in their previous companies. So that's actually really cool to see as well. Some people just skyrocket within the new environment.
Because it's just like a better environment for them, and
It just works. Yeah. So we actually discovered a lot of people that somehow they were underutilized, or they were just definitely not hitting their potential. And right now, it's amazing just like how much people can develop and jump into. Another of our values is basically take responsibility, which is basically people are just jumping in, taking responsibilities into things that we were not expecting that they would, and they just grow. And we use those cases a lot as examples, and this just keeps fostering the movement and the change. And I think this has been working actually quite well.
Yeah. And another thing that stood out to me in our prep call was that you were describing your executive team composition, and you have 5 executives with 5 different nationalities. And you said something very interesting, that you sometimes juggle executives into situations depending on the cultural context. Can you give us maybe an example of when that really mattered during integration?
Yeah, I think that this is actually very powerful for us because, so first, we are all aligned and we all want the same thing. And I think this is super important. There's not much politics. So the fact that we all always show up as one helps us to play around in different contexts, right? So one example is one of our executives is a super friendly Canadian guy that just has a very natural rapport with anyone you meet. Within our executive team, besides me, nobody speaks French. Bring him on board and say, hey, help me to build a connection with these people, to be like a sparring partner and create empathy and trust. But then at the same time, we actually bring a German or Wouter, right? Wouter is a Dutch, so he's a very straightforward guy to push and be the bad cop and say, hey, we need to stick into this. We have to get this done. So we like balance each other in a situation where you first need to build the trust and then you need to get stuff done. So I think that's actually quite helpful.
And maybe on this note, because like culture can be seen as the company culture, but really also the different backgrounds, the different nationalities, and communication styles differ massively across European teams even. And for example, you mentioned the example with Wouter, but also like French teams, I'm generalizing, but like often communicate with strong opinions, more emotion, while Germans or Polish teams tend to be more direct or flat. And you also once said that the real skill is saying the same thing, but in the right way for that culture. So, can you maybe give an example, maybe also Wouter, how that looks like in practice for leaders integrating teams across countries?
Yeah. So again, of course, generalizing a bit, right? And
Yeah.
even within France or Germany, people from the north will say that the south is different, vice versa, right? But generally, I could see in my teams, for instance, that if I look at my French colleagues or the questions that I get there, that if you're saying we're changing this process, we're maybe, I don't know, changing a manager of a team or whatever, right? In France, they really just want to know the why. Why do I now have a different manager? Why are we making changes today? Where in Germany, they just want to know, okay, what's by when? When do I get the next piece of information? When am I supposed to do something? They just want to see the steps and a clear plan. And in Poland, they think both situations are too much information already, and they just want to hear we're changing managers, and then that's it. It's a very easy conversation there. So you just have to think, okay, in the end, maybe the message is we're changing a manager for the different teams, but then you're bringing it very differently, maybe with a bit of additional information. And also, do I bring it in person? Do I bring it in a structured slide deck? Or do I just send a simple Slack message? Yeah.
Yeah. And on this notion of culture, what we often see, and I've also talked to many founders like expanding, for example, especially to the US. And what you then often see is that one of the founders actually goes there to really instill the culture. Also, what is our kind of way of doing things? What is our ambition level? What is our quality of hiring and so on? And I know from you that the concrete example that you have is the one in France, where you eventually placed your GM from inside Shiftmove. So somebody who has been with you for quite a while and really knew what was important to you. So why was that so important to you? And can you maybe give some stories around it?
Yeah, so I think, of course, there is always the trust factor, right? Know what you get, and that person is aligned with your story and you and what you want to build in the company. There is also, I think, one thing that is super important is there is no politics in the end, because what can happen is once you get a new GM or a new country manager or something, these people, they want to make their territory the most important of the world. And because of this, they start closing up and defending and trying to really build this little empire or something. And I think this can become really risky because if you're trying to integrate a company into a bigger vision, every piece of it is important. So having someone from the inside, I think the low ego, no politics game with this combination of trust, cultural alignment, and of course, internal knowledge of the product, of the customers is it's a much better recipe for success. So if you have the option, which I think it's not always the case, right, unfortunately, but if you do have the chance, I would always go for this option. It's just not available all the time. Yeah.
Yeah.
And maybe one thing that I must also say in this case, we were not lucky enough to we didn't have the luxury of having a good successor within the companies that we have acquired, but I actually have seen this working quite well with a few of other companies that I talk to, where you're acquiring a new company and maybe the leader of that company becomes the new GM, especially because in the sales process, you can identify if that person is really buying your story. That person is also working in the same industry. And if you have a very good cultural kind of like fit, it can actually work. It just didn't work in our case because we didn't have the option.
Yeah. And now, before we head into the rapid fire question, I have one last question. So to sum up like many of the things that we were talking about. So if a founder is listening today and is about to do their first acquisition next year, what is maybe one thing that you know that you wish someone had told you before your first deal?
For me, it's the focus on the integration afterwards. So I think in your mind up front, you think the acquisition is the big part and then the rest comes after. I think it's more the other way around. Actually executing on the integration plan, starting from day one, I think it's critical and probably takes or should take much more thinking and effort up front than what you might expect. Because 18 months or maybe even 2 years after acquisition, that's where you really create the value and where you can see if the acquisition was worth it, yes or no.
Yeah. And so for me, it's if it's a really important acquisition for you, what I would say is go and stay for 2 months, the first 2 or 3 months at the location and show up every single day and talk to the people so we really understand what's going on. You build the trust and that will really pay off.
Very nice. So let's close with a quick rapid fire question. So short answers. First up, biggest mistake founders make when considering acquisitions?
I think, like we keep saying, this is underestimating this integration. And I think another mistake is sometimes you look into a company and it's a bit of a stretch of your vision. And you'd start creating stories and theories just to like fit. So that you can just be lured by a vision that actually does not make sense.
That tells you a target company is a great fit.
For me, that's a strong customer retention, right? If customers are happy and are happy with the product, then it's just much easier to work on your growth or your profit margins or whatsoever.
Yeah. And I would say at least a little bit of a level of profitability just to add, but the customer retention is definitely the top.
The integration mistake that hurts companies the most?
Yeah, I think, like we said before, you have to start early with your integration plan. And that sometimes means making tough choices and having difficult conversations with people and delaying those decisions simply because you feel uncomfortable with having tough conversations is probably something you want to avoid.
Agreed.
And one thing founders should prepare for before they acquire their first company?
Look into how your management team over there will look like because you need those people.
Thank you so much. Last question of this conversation. For founders who want to learn more about your work, maybe want to work for Shiftmove or get in touch, what is the best way for them to do that?
I think it's basically just finding us on LinkedIn and setting a message.
Awesome. Thank you, Wouter and Francine, so much for doing that with us. Yeah, and really exciting to observe where you go next. We already line up the next conversation, so thanks so much. And
Thank you, Melanie. Yeah, hope to see you soon.
And this was another episode of our Follow the Gradient podcast.
And now we would love to hear from you. How did you like it? What should we improve? Do you have any suggestions, ideas, or dream podcast guests? Please let us know.
Thank you and see you again next week.